Eddie, good afternoon. How's it going?
Hey, doing great, doing great. Glad to be back here, and it's just these are fun to do. Obviously, very important for people, and just a kind of another platform for us to continue some communications we've had with folks already, but on a bigger scale, and kind of summarizes some things for individuals. So,
Absolutely. Market's been tough, but I am very fired up to be here today. So, if you normally listen to this on a faster speed, maybe slow down because I'll probably talk too fast. So, just throwing that out there.
yeah,
So,
yeah,
it's been challenging, but I think this is where we hopefully add value to our clients is just helping them understand the markets and also position so they're safe for the future. And for every client, our number one goal is to make sure that you're going to be okay, kind of regardless of what comes. And that is our mo as we put everything in place and continue to do it. And even though we're going to talk about both some positive and negative things today, and it could be easy to leave and say, oh, things are getting worse. And if you read the news, that's out there a lot. Um, every single client that we have, when we talk about investments, we position in a way that we think gives you the best probability
hmm
of achieving your goals and getting where you need to be. And that's the most important thing. Investing is not about how do I make the most money. We don't have any client that says, just give me the highest return, double my money
hmm
in a year or something like that.
yeah,
Um, because that's just not who we work with, and that's not how we structure things. It's all about a methodical approach, very structured, intentional academic approach to investing for the long run so that you can live the life that you want. So
yep, yep,
kind of with that, let's jump into some negative
yeah.
things first. We're
Go
just going
ahead.
to share a chart so far, as we always do, kind of talking through the markets year to date. So I think you can now see my screen here.
hmm
So this is same chart we show every single time we do these meetings. Kind of start off with year to date, what's happened so far in the market. And as you can see, every major asset class is down. Best performer is only down 6.5% as of yesterday. That would be um, September 7th is the data through here. Gold down 6.5. Worst performer has been the QQQ, which is the NASDAQ, mostly tech stocks, US tech stocks, down 25% almost. And you see, the big one that jumps out to me is down 11.2% year to date is bonds. And this includes interest and dividends. So we're looking at total return here, not just the, price on the index. And so that's pretty surprising for a lot of clients to see, oh, my bonds are down. Stocks we know go down, but bonds, it's been many years since bonds have come down, especially at this level for this long, as you see over here.
Yep.
Then obviously you've got total stock market, you've got developed market, emerging markets, all down 16 to 21%. Anything jump out to you, Eddie?
Yeah, no, I mean, I we say this over and over and over again. It's the just a quick turnaround from a year ago where we were to where we are now. And I remember 2021, things were still kind of flying pretty high, coming off of 2020 from
Mhm.
the surprise of COVID and all those things. So you have this kind of dual dragons, if you will, where you have markets are down, all these asset classes are down, and then you combine that with some of the narratives happening from the world events, and you have the expression is if it bleeds, it leads,
Mhm.
and you have these confluence of things that are playing on our emotions. And while we understand that, and we're not diminishing some of those real things that people feel, we we try to put things, as you mentioned earlier, in perspective so we can take the emotion out of it, and we can add some very rules based, very logical long-term thinking with some historical data there to give folks the highest probability of return for their portfolio, for their individual lives. And again, investments is a big part of it, and it's what you feel the most, but there's a lot of other things that go into this. Give you a good story. So sometimes what we feel, even though it may not be real, it feels really, really real. So my son, who's 9 years old, he's last couple of days he's been waking up the middle of the night, afraid, saw something probably at the store or something from Halloween, and he's waking me up every single night. for the last 2 to 3 days, and I put him down every single night. I hug him. I say, "Buddy, he's gonna be okay." But he tells me the same thing for the last couple of nights. He goes, "Dad, I'm scared," and then I end
Mhm.
up laying with him to make him feel comfortable and safe. Nothing's unchanged in the environment of our home over the last couple
Yep.
of times, but he feels scared,
Mhm.
and that's a very real emotion. So, what we're trying to do is understand that people feel scared and they
Mhm.
have a legitimate reason to feel scared, but we're trying to assure with logical things that are probabilities
Mhm.
that are real, that actually are can change that narrative of that thinking. And we talked about this a little bit last video. We're focusing on probabilities, not on possibilities. Any infinite amount of things can happen, are
Mhm.
possibilities in life, and those things could make us feel trapped and unable to do things. Like, I could not leave the house because I'm fearful I'm going to be in a car wreck. But the possibility of that is so low that I don't want that to ensnare me and enable me to make logical decisions that could enrich my life and be for my benefit. So,
Mhm.
kind of contrasting, obviously, with the numbers we've seen there with those charts and some of the other things you're going to see is, we're working through all of that from a financial planning psychology perspective, but also from a real basis of like looking at portfolio asset classes and things that are happening. So that's
Absolutely.
kind of a long-ended answer to your question.
No, for sure, and I think that's obviously really important to keep in perspective that we try to focus on financial planning first, and what are the goals that matter, and what's important to our clients, and everything else, and the investments are just a tool to help you reach your goals.
Yep.
And we expect, like, just broadly, and we've talked about this before, we expect 2 out of every 10 years you're going to lose a significant amount of money in your investments.
Hmm.
Just put that in your mind. 2 out of 10 years. Well, let's look at the last 15 years. Basically, since the great financial crisis, you've only had 2 years
Hmm.
that things have really dropped. This is one of them,
Yeah.
and that is it's when you live in it. If you see it on your portfolio statements, it's scary. It's hard to
Yep.
be comfortable with. But I was just talking to a client late last week, and what I said is, our portfolios have done what I would expect given the environment. We can't change the markets. What
Hmm.
we can do is position to be in the best position, highest probability of achieving success going forward. And
Yep.
so we're going to talk about some negative things, particularly with international, some concerns economically that we see here for the rest of this video. But stay through to the end, because
Hmm.
we're not just sitting idle
Yep.
letting things happen. We're not going to go wholesale change and bring you all to cash, but there are some things that we can do. But at the same time, we have a really good portfolio for our clients that are,
Yeah.
it's well diversified. On all, that's why we show you these charts with all these different asset classes, because you are exposed to a lot of different areas, because we're not trying to bet one way or the other. We want
Hmm.
to give you the highest probability of success. So
Yep.
with that, let's look at one thing that's a little bit more positive, and that is, even with what's happened so far this year, if you look at 5 year charts, this is 5 years as of yesterday. Um, this is total return, so including dividends and interest, total return of the same asset classes. So if you
Hmm.
had just put your money in 5 years ago, fell asleep, woke up yesterday,
Yeah.
and you had tech stocks, you'd up 113%. Remember, that's the worst one so far this year. If you just owned US stocks alone, you're up 72%. Bonds are the worst, only up 1.6%. So this is total return. So that is ridiculously low for a 5 year
Hmm.
time period. Still positive, though.
Hmm.
Then you've got international and emerging markets are down in single digits, so it's not great. And again, that's part of what we're going to talk about. And then we have gold is up about 25%. So I look at this and I say, if you just invest for the long run, the longer out you go, the better off you're going to be. And if in 2018 someone had said to you, here's what's going to happen going forward, we're going to have some continued political instability in the United States
Hmm.
of fractioning, and you've got COVID, and everything's going to shut
Hmm.
down, you're not going to leave your house for a year,
Hmm.
and then we're going to have Russia invade Ukraine, and that's going to continue for a long run. Oh, and we're going to have lots of inflation over that period of time, which no one's experienced since the 70s and early 80s.
Yep.
And through all that, if in 2018 you would say, I don't want to own anything, give me cash, like just get me out of
Hmm.
it. But if you just invested and kept staying invested, you're going to be fine. I forget who said it. You probably will remind me, but I go back to it all the time. It's not about timing the market. It's about time in the market. And
Hmm.
that was a quote in a book we actually as a team just read,
Morgan Housel.
reread. I've read it
Yep.
3-4 times now, but it's called The Psychology of Money. It's a great book. If you
Yep.
want to give it to anybody, you got a college student in your family, go give it to them, have them,
Yep.
get started. But there was a quote in there and attributed to somebody else. But anyway, it's about time in the market, not timing the market, not
Hmm.
guessing when this is going to flip
Yep.
or anything
Yep.
else. So, obviously, clients that have been with us for a long time, they've owned kind of all these different areas. They've got a mixture of their portfolio, have had positive returns over the long run. Even though we don't have any clients that haven't lost money this year,
Hmm.
that's okay. We expect that to happen sometimes.
Yeah.
That's part
It,
of the cost of investing.
yep. Well, under the point of diversification and, reviewing, rebalancing, making sure if it's something's out in the upper or lower band and making trades within the portfolio as it's the portfolio dictates that. We're not, the emotional side of us are not dictating it. And it was a gentleman in our industry named Jim O'Shaughnessy. He says the four apocalypse of the investment apocalypse is fear, greed, hope, and ignorance. And he talks about fear, greed, and hope all being emotions that are responsible for the most significant mistakes that investors make in their lives,
Mhm.
and ignorance being the non-emotional one. And up until a couple years ago, 2020 and the beginning parts of 2021, first maybe half, there was a lot of greed, a
Mhm.
lot of greed about things, and not thinking, okay, well, this asset class is high. Let's take some chips off the table and buy the asset classes that are lower. And then now we've kind of flipped to the other aspect of it, which is this fear, when it's just not being in the market, to use the aspect of time in the market. So um that emotional side, the more we can remove that from it, the better we're all are going to be. And this is precisely why we do the risk management. This is precisely why based on the risk management and conversations with clients, we have a portfolio construction that fits their risk management or their risk tolerance and also their time horizon, because those things dictate what we're buying and what we're selling within that asset class. And you have a broad-based diversification across multiple country sectors and even the U.S. market. And it's the best long-term strategy. And I know it's not easy to hear that now when you're losing money, but to your point, every 2 years you can expect to lose money, and we just happen to unfortunately be in that time frame
Right,
of late. So.
for sure. Well, that's a good segue to kind of our next and kind of core economic topic we want to talk about today, which is about international investing and some things that we are aware of, some things in Europe particularly that are concerning as we look ahead
Hmm.
economically, but at the same time present some nice investment opportunities if you are a long-term investor. So I'm going to start with a question. I did not tell you this was coming, Eddie. So here we go. Since 1920, since
Okay.
1920, what percent of the time do you think the US has outperformed just international stocks in general? So non-US stocks. What percent of time?
Oh.
What percent of years? So looking at
uh
years since 1920. So we got 100 years of data here. What percent of the time does the US outperform
I'm gonna say
stocks?
65% maybe.
Okay.
It's a rough
So
guess. I have no idea.
I know. I didn't set I set you up to fail. It's fine. So 55% is the number
Okay.
since 1920. So 55%, which is close to a coin flip. I mean, it's a
Hmm.
little bit more. US does better, but about half the time, a little more than half the time, the US stocks do better than international stocks. But that
Hmm.
also means about half the time international stocks do better.
Yeah.
Now, since the great financial crisis, I'll go ahead and see if you can answer this one. What percent of years do you think the US has outperformed? Hint, it's a
Since
lot
the
higher.
grid, I'm gonna say probably 80%.
80%.
Okay.
80% of the time, US stocks have outperformed international. And so what's interesting is we all fall prey to some biases. And one
Mhm.
of them is just what's most likely to happen, a recency bias. What
Mhm.
is the most likely thing? What is the most recent thing to happen? I misspoke there. And that is, well, if you look the last 15 years, why would anyone own international stocks? US
Yep.
stocks have done so much better. And in aggregate, you saw that 5-year chart. I mean, international and emerging markets haven't done that well.
Yep.
US stocks have done great. Why would you own any international stocks? Well, if you zoom out a little bit and we take a look at markets as a whole and not just expect that the last 15 years are exactly what's going to happen in the future,
Mhm.
we want to make sure you have international and will continue to buy as things go low. So you made a good point to me before I shared my charts, because I've got plenty of them. You made a good point to me, which is I think clients need to continue to hear our disciplined approach
Mhm.
is we take a long-term view. So we do 10-year expected returns
Yep.
for every asset class, which means whenever something is doing really bad, the worst performer, that's what we're going to buy.
Yep.
We are always buying what looks the worst.
Yep.
And I've been in the industry long enough to know that is maybe the hardest concept for clients to understand,
Yep.
because what do you do when you open your Schwab statement? You
Mm.
probably jump and see what's down the most, right?
Yeah.
And you say, why do we still own that? And then I come to you and say, actually, we're going to buy more. Uh, you want to sell, we're going to buy more. And
Yeah.
also, by the way, if something's really up, we're going to
Yeah.
sell a little bit of that and
Yep.
buy whatever's the worst. And conceptually, that's hard to understand, but it gets us in the discipline of buying low, selling high, which is what we want to do with investing. So, with
Yeah.
all that said, I'm going to tell you why the international stocks are down, but I'm not going to then follow up and say we're going to sell. We actually might buy more as we continue throughout the next 6-12 months, if international continues to stay cheap. So
Mhm.
with that, one thing I want to point out is we're going to start with the euro to US dollar exchange rate. And that is really important because um, when you're looking at international stocks, they're actually an additional factor to return. So it's not just the earnings that a company has, but it's also the exchange rate. So if you look at this chart, this goes back to the late 90s. You can see the euro to the dollar. So right now we're just under one, which means 0.989 euros to $1. You can
Mhm.
see that most of the time it's been above this line here, $1 that you have here. It's actually peaked at about 1.6 euros to dollar. This goes back right before the great financial crisis. You can see that really fell off a cliff there.
Mhm.
Um, but what's really interesting is if you overlay this with a chart of US and international outperformance, as the euro appreciated in value, which also is another way to say the US dollar depreciated, it was worth less compared to
Mhm.
other currencies. European and developed international stocks did better. The 2000s up to the great financial crisis, international stocks outperformed US stocks. That is what happened if you look back at the history. Since basically this peak, international stocks have underperformed the US. So there is a direct correlation here between, as the dollar does better, US stocks do better in comparison.
Mhm.
Now, what does that mean for today? Well, it means we are on this downward slope that's gone on for a while here. And now we're at below the dollar parity where it's 1 to 1. And that sets us up for possible outperformance from today going forward of international stocks. So this explains part of the loss in international stocks compared to the US, but it also allows us to buy in now that even if international stocks have the same economic conditions as US stocks, you could have outperformance because the dollar could do worse, which allows you as an investor to benefit from international investing. So I know
Mhm.
that's kind of a convoluted way to talk about it, but it is a very important part of international investing that because we're not hedging back to the dollar, this really matters for the returns that you get as a U.S. investor spending U.S. dollars there. Now, that being said, my family and I are considering going to Europe next year if this continues, because our dollar's worth a whole lot more, to buy some things there. And but
Yeah.
that also does create some downward pressure if the dollar is so powerful compared to other currencies. That's actually not the best thing for U.S. companies. It's good for U.S. consumers,
Hmm.
but it's not good for U.S. companies. So
Yep.
before I move to kind of the next chart, what are your reactions to that?
Yeah, no, I think I you're saying that, and I'm thinking of a Buffett quote. He says there's a difference, but there's a correlation between price and value.
Mm-hmm.
And what he says, he goes, price is what you pay, value. The price is what you pay, and value is what you get. So part of this is again, most individuals are concentrated on the price of things.
Mm-hmm.
In investing, we're looking in terms of investment management. We're looking at value. What's the most value has the future return at the best,
Mm-hmm.
and there is the price that most people see, and then when we have conversations with clients, it's usually related to price, but there's a significant amount of other inputs that either just in that chart, the exchange rate, and there's a lot of other things that going on. I mean, you look at what's happening with the Fed rate and fund rate, and that happening coming up soon, and all those things that are happening from a monetary,
Mm-hmm.
fiscal policy. There's things that affect, financial markets. So we're not majoring on those things, but we're also not using what we talked about in terms of the four horse the four the apoc four the four horsemen of the investment apocalypse, which
Mm-hmm.
is the last part of it. It's non-emotion, it's ignorant. We're not
Mm-hmm.
ignorant to those things. We're aware of them. We're looking at them, study them constantly, scanning for those things to see where there's risk, maybe
Mm-hmm.
risk. And, but to one point, actually, you shared this with me maybe a couple weeks ago, is um, a lot of times risk doesn't change significantly. It's the perception of risk
Mm-hmm.
that affects how individuals react to that. So obviously, risk and managing that risk for individuals is a big part of what we do, and so we're looking at those things. So long story short, the price and the value are very intricate parts of looking at the portfolio.
Absolutely. And and I think, as you said there, kind of at the end about the tolerance of risk may not change, but our perception of the risk is an important piece. It's similar to, and I forget the official psychology term, but um, the bias of when you drive by a cop and you're speeding, you slow down after the fact, which it's too late at that point, right?
I may
But
have done that this weekend.
shocking, shocking. Um, I think we've all done that at one point or another.
Yeah.
And you slow down after the fact, and you're
Yeah.
probably slow for a little bit of time because it's in your mind. It's right there. You're thinking about it,
Hmm.
and your risk of being caught speeding hasn't changed,
Mm-mm.
but your awareness of
Yes.
that, the perception of your risk has just gone up.
Yep.
And so that's similar to investing. You look at it right now. I've said for years, 2 out of 10 years, we
Yep.
expect you to lose a lot of money in stocks. That hasn't changed. I mean, we actually have had less than that since the great financial crisis.
Yep.
But everyone's aware of it now. It felt really
Hmm.
easy in
Yep.
2020 and 2021 after the COVID recovery. It
Yep.
felt easy to invest, and that's why you had a lot of people investing in whether it's meme stocks or crypto or their Robinhood account, all kind of related there.
Yep.
And we had clients come to us with portfolios that thankfully we got out of a year ago
Yep.
because they were all the NASDAQ stocks, because that was what was easy. And
Yep.
you didn't think you were taking a lot of risk, but we're taking a very academic structured approach. So
Yep.
with all that said, let's talk about Europe, specifically some concerns that we have. So
Hmm.
it seems to me when I read general news, not just and financial news, um, there's not as much about Ukraine as there used to be. We
Hmm.
had that initial Russia invaded. It was on everyone's mind. You had the stories that we're all going to die in a nuclear holocaust. All those fun things. And then the news media moved on, and it moved to other things. Well, there's still war going on.
Hmm.
And that is, if you think back to our other videos, we've talked about this winter being a
Hmm.
concern with not just in Europe, but internationally, especially world countries with lower yields on crops from Ukraine and Russia.
Yep.
You got concern with food prices because of the potash that's in the fertilizer, and that impacting things. Well, we haven't yet seen all that play out, but it will.
Hmm.
But one huge thing that was in the news a lot last week was about energy.
Hmm.
And you actually sent me a Bloomberg article, and the headline says
Oh yeah.
Goldman Sachs
Yep.
sees $2 trillion surge in Europe energy costs in 2023. I
Yep.
mean, that number is massive. I
It's
don't think any
crazy.
of us know what $1 trillion actually is. Like, you can't imagine it, but that is a lot of money. And you've seen a lot of things come out recently, the last couple of weeks, of governments cracking down on the amount of energy that's being used, and we are only in September. And so
Hmm.
there's a lot of concern of what this means for the economy and for the people in all of Europe,
Yep.
um, if there's not enough energy this winter. And if it's a cold winter, that could be really, really bad
Yeah.
for lots of things. And um, I've mentioned this before. I'm a big history buff. I was a history minor just for fun.
Mhm.
And so, because I wanted to go to history classes, it was a good time. Well, in every major political instability in history, there's either people are cold or they're
Mhm.
hungry or both.
Yeah.
And so there's a lot of concern of what that means around the world. I'm not predicting that we have some massive revolutions or any of that stuff, but when you have instability, people don't always make the best long-term decisions.
Hmm.
And so an example of that is Europe has just announced, the ECB, or Europe Central Bank, has just announced that they're going to increase, or they're going to allow more liquidity in the market. And actually, the UK is printing some money and giving stimulus checks to help pay for energy. Well, we know where that works out. That's part
Hmm.
of why we have inflation where we have now.
Yep.
That is not great from the long term.
Mm-mm.
But you don't want to be the politician that says, I don't care that you're hungry and I don't care that you can't, heat your house. Um,
Yep.
People make short-term decisions because of multiple reasons. And so with that, I think there's a lot of concerns of Europe in particular going into this winter and going into early next year, that we could have some downturns. And that's going to affect US companies too. US companies, 30% of the S&P 500 earnings happen abroad. That will really matter. That's part of why you've seen some of what you've seen with the dollar
Hmm.
appreciating compared to other currencies.
Yep.
Okay, what do we do with that? Well, honestly, as a long-term investor, that gives us some opportunity to buy some things cheap.
Hmm.
If you look at international stocks, they continue to get cheaper for a US investor putting US dollars to work. And when the stocks don't perform well, that allows us to buy in at an even cheaper price.
Yep.
And everything that we invest in stocks is for at least the next decade. We don't put any money in stocks that a client needs for the next 10 years.
Yep.
That is just the way we approach it,
Yep.
which means we can let this play out. We can let turmoil happen, and you as an investor won't be affected. Now, there's a human side of everything,
Yeah.
and we're not really discussing that here,
Yeah.
but it does create some opportunity that we as investors want to not be afraid of and go ahead and buy when things are low.
Yep.
Um, Before I move to bonds, I just went on a whole rant there. So why don't
Yeah.
you
No.
say
No. I
something
think
else?
I think that's good, and I'm a very practical, kind of plan-oriented individual, and I think kind of using the four horsemen of the investment apocalypse is, the other one is hope, right? Like you have a hope that things are going to work out and not, but like, listen, when we start, we work with folks. If there's any significant changes, we kind of reset, but we go, if they're working individuals, we do a cash flow projection. Just recently we met with a retired client who had some concerns. We talked through portfolio, we talked through cash needs, and then we realized that there was a cash liquidity issue, that she wanted more cash available to her in her account. And that is a completely valid thing for her specific situation and time horizon. And we dealt with a completely different situation. I think we talked about him last video as well, but a husband and wife, he's working, they've got a plan. they're down in their portfolio as well, but they actually feel good about the plan. They sleep well at night. And even the wife said it's a mindset of how you do it. And that for me was like something that was important. Like they taught me something in that lesson. It's like, so we're not hoping that we're just putting these stuff together. Like there is a very tactical, very intentional way of all the things we do for individuals to help them and guide them through these things. And in that particular two examples, there was two different outcomes and two different things that
Mhm.
we needed to do. So that's why you always say in these videos, if you have a concern, is there something you want to talk about? There may be some underlying issues, and this is really hard for us sometimes to understand. Is like a lot of times we don't even really know what's bothering us,
Mhm.
like, and that's why a kind of unbiased opinion will be there, and that's why we tell folks all the time, send an email. Let's get something on the calendar if you're concerned. Let's talk about it because we may be able to uncover what is driving that fear and walk through that and provide a different perspective. Because if not, we get in this echo chamber and all
Mhm.
we hear is these things that are probably not true,
Right.
and maybe they are true. And then we just figure out a way how can we help you through some of this stuff. So
Absolutely. I think we are in this we're in this field. Yes, I like numbers, like talk about bonds and rates and all that fun stuff, in my mind fun. But we're really in it because we want to help our clients. I mean,
yeah.
that is why we do what we do, and we feel that we have a responsibility and an obligation to our clients to help them steward their wealth in the way that fits with where they are. That's why stewardship's one of the core values of our business.
Hmm.
We do that internally. We do it with how we work with our clients. And so with that, um, part of being a good steward and helping you with your money is helping you kind of work through what's going on in your head, and why are you worried about it, and what are you worried about, and all of that. And so that really, I mean, I will just say at the end of the week, I don't look back and say, oh well, our clients earned X amount of money, or whatever else. It's the number of clients we helped. That's what motivates me. That's what gets me up every day. That's why I launched Illuminate, for that. So we're here. That's what we're here for,
Yeah.
to kind of go through that. I will add one thing just as a reminder. We've talked about this with a few clients before, but we did add earlier this year, this spring, we added a pretty deep bench to our investment team. And so
Mhm.
we have our internal kind of investment committee, and we have that, but we have a team of 40 chartered financial analysts and other people that work with us that do investment research. We have a weekly meeting where I, as chief investment officer, are working with those individuals on the research team, and we are able to really dive deep into all this stuff. That doesn't mean we're placing a lot of trades, but it just
Mhm.
means we have a deeper bench to kind of uncover some things, and also just have a good pulse on the market. It also, candidly, it gives me time to meet with more clients. It gives me
Mhm.
time to have more interaction with the clients, which is what really this is all about. And it's not
Yep.
about how much am I stuck in a spreadsheet over here.
Mhm.
And so with all that, just as a reminder, all of this is very intentional as we put together portfolios for our clients and
Yep.
everything that we do. So let's kind of wrap up with, where do we go from here? So
Mhm.
kind of to summarize, it's been a tough market so far.
Mhm.
Nothing's really changing. There are some economic reasons, whether that's raising interest rates, whether that's everything going on with Russia, Ukraine, or the rest of Europe. There's a lot of reasons to be a little bit concerned. And if I were to make a prediction, I would say I think it's more likely we go to recession than not, through all that. But that doesn't change us as investors. We are still focused on the next decade plus. We want to invest for the long run. It's time in the market, not timing the market.
Mhm.
And so through that, we are going to maintain our investments. Um, we are also okay with having a little bit of cash, and
Mhm.
that's been kind of the way it has been for a lot of this year. As bonds have come due, as people have added more cash, we've kept a little bit more cash than normal in the portfolio. And that kind of, I'm not going to go sell a bunch of stuff to generate cash, but if it's there, we're not going to be overly enthusiastic to go buy in immediately.
Hmm.
So that's number one. Number two, interest rates have really gone up. That has led to prices of bonds dropping. That's why you've had those negative returns. But it also allows new money going into bonds to be bought in and locked in at a higher interest rate. So we talked, I think, last time and the time before, if you've got
Hmm.
extra cash out there, maybe you should consider buying a T-bill, buying a short-term treasury bond. 3-month T-bills are over 3% right now. That's crazy. Risk-free, you can get
Hmm.
3% for 3 months. That's awesome. And if you go longer, you can have a little bit more. So some of that cash that we've had for clients, we have started to put to work
Yep.
into T-bills, 3-month, 6-month, 9-month. Then in 3 months, that T-bill is going to come due. You've earned some interest. Now you have cash. Then we'll see where we are in the market. Maybe we buy another treasury bond at that point. Maybe we buy
Hmm.
more municipal bonds at that time. Or maybe we go buy some stocks, whether that's international or US stocks. Through that process, we're not betting on the timing. Just like we're not betting on the timing today by investing everything in, we're also not betting that it's going to be better or worse 3, 6, 9 months from now. But we're
Hmm.
going to take a very systematic approach, have some money in bonds. We're going to buy more bonds now. First time, I said this last time, first time in a while, I've been excited to go buy bonds. When we can
Yeah.
buy municipal bonds and lock in 3, 4, 5%, depending on the bond and if it's taxable or not, all those things. I'm pretty excited about that because that
Yep.
means if we hold that bond to maturity, you're going to get paid and you're going to make money on that bond, and as long as it doesn't default. And so, with that, you probably will see a few more trades throughout the rest of this year. It's not because we're changing our mind; it's really about having kind of what I'd call dollar cost averaging, of putting money in at different times and letting markets do their job. Which is in the long run, we expect that to continue to go up.
Yep. Yeah. No, that's good. Hey, and as you're saying, I was thinking back to where we talked about the Tom Brady effect, where he had his whole thing in his career was 1% each every day. So this is part of that 1% kind of incremental adjustment or small little pivot. But from the long term, again, we believe that time in the market is more important than timing the market.
Hmm.
To reiterate what we said earlier, and once again, we say this over, but we say it because we believe it. We believe it's the best, most prudent, most probabilistic, secure outcome for
Hmm.
all individuals, for ourselves included. So, it sometimes being reminded and kind of going through why we do that and through the rebalancing and how those models are constructed and the conjunction with time horizon, all those things are, we are always talking about those and trying to just let folks know that there is a systematic way of how this is being
Hmm.
conducted. And it's not just by chance or
Hmm.
to use the four horsemen, it's not ignorance or hope. It's a very planned out process.
Absolutely. Well, I think on that note, I think we can wrap up. I mean, I could talk for another hour, but no one is going to keep watching,
No,
so
I
it's
don't
fine.
think they will.
Come on, come on. You don't want to just hear me all the time?
Well, some
So,
probably have diapers to change or
okay,
something else they
sure,
want
sure.
to do. So,
Sounds good. Sounds good. So, Eddie,
uh,
thanks for your time today,
absolutely.
and clients, if you got any questions or anything, definitely reach out. That's what we're here for. So,
Everyone, take care.